Hello, this is Alex Stanczyk, and welcome to another edition of the Gold Chronicles. This one is for March of 2018. I have with me the brilliant Mr. Jim Rickards. Welcome, Jim.
Welcome, Alex. Great to be with you. Thank you.
So just really briefly, in our last episode of the Gold Chronicles, we covered a couple of different things. Number one, why exploding sovereign debt and the debt to GDP ratio are critical to market stability in the next few years. How student loans at about $1.5 trillion is a big problem, and it's got a significant default rate. This is going to affect other things. What the two critical conference boundaries are and how we might cross them. And then finally, we did an interesting potential scenario. Jim wasn't calling this a forecast, but it was a 3-year playbook. So if you're interested in seeing those, you can access the archive of all of our podcasts that we've done at the Physical Gold Fund or physicalgoldfund.com, physicalgoldfund.com/podcast. So why don't we dive right in, Jim? The first topic up on deck is gold. I'm not going to prompt you at all in regards to this topic. I'm just going to let you run with your thoughts. Let's keep this one super short because we've got a couple of more that are really important. But what are your current thoughts on gold right now?
Sure. Well, just a very big picture, as I mentioned before, and I won't spend a lot of time on this. We're in the third great bull market of my lifetime, actually kind of the third bull market in history. And the reason I say that is prior to 1971, or in different ways, 1933, the world was on a gold standard, and you really didn't have bull markets and bear markets in gold because the whole idea was that the money was gold or the money was backed by gold. And either way, it was a constant store value and a constant exchange rate. So people were just happy with that. They weren't looking to make money on gold. Gold was money. It's only in the 20th century that when countries went off a gold standard, you had to say, well, what's the ratio of dollars to gold by weight? Now you get these bull and bear markets. So I can say it's of my lifetime, but maybe it's all of history. It's just a new world we're living in. But that said, the first bull market was 1971 to 1980. Gold was up well over 2,000%. The second bull market was 1999 to 2011. Gold was up almost 700%. And the third bull market began in December 2015, and it's running today and will run for many years to come. And in my view, this is the one that's going to take gold up to $10,000 an ounce. Now, I don't want to go through all the analysis behind that, Alex. You know, I don't like to make claims without the analysis. I just made a claim about the bull market, but we did provide all that analysis in a prior podcast. So just to kind of update that story a little bit, gold has been strong very recently, up back to that 1350 to 1355 level for the third time in the past 3 months. And, it fluctuates. It could be down tomorrow and up again the day after that. We all understand that. But what strikes me the most, and to me the real story on gold right now, is that gold is showing a lot of strength in the face of very adverse conditions. Mm-hmm. Two charts in particular caught my eye. One was it was a comparison of gold to real interest rates. And the real interest rates were shown on an inverted scale, meaning if the line went down, that meant interest rates were going up. And these were real interest rates. So using 5-year tips to strip out inflation, because the principal is adjusted for inflation. This was just, as I said, the real rate, the so-called term premium. And the other line on the chart was the dollar price of gold. And that was on a normal scale, so up is up. And what it shows from 2013 to 2017, and if you take it back even longer, the pattern is very similar, is that those are highly correlated. They go down, up, but they move together, high degree of correlation, and that makes sense. Money and bonds and notes compete with gold for the investor dollar, and gold has no yield. We've talked about that before. It's not supposed to because it's money, but in fact, it has no yield. These other instruments, whether they're bank deposits or 5-year notes or 10-year notes, do have a yield. So the higher the real yield is, the more the investor is inclined to buy the note, not buy the gold, because they can get a higher return. And with lower real yields, gold looks relatively more attractive because the opportunity cost of holding it is not lower. Now, to me, that's not the reason to hold gold, but for a lot of people, it is the reason to hold gold or not hold gold. So that's a very meaningful figure. So the fact that they were correlated makes sense, except beginning in 2017 and continuing today and getting more extreme by the day, those lines diverged. All of a sudden, real interest rates were going up, continuing to go up, which meant that line was going down on the inverted scale, but the dollar price of gold was also going up. So you had this correlation. All of a sudden, gold goes like this, real interest rates go like this, meaning they're going up, downward sloping line is up. And you had this spread opening up between higher real rates and higher dollar gold prices. That's highly unusual. That when you see that, it tells you something's going on. You have to ask yourself more questions because that is a highly unusual pattern. And there are a couple narratives you could apply to that. The first one is one of them is wrong. In other words, well, I mean, the market's never wrong. The market is what it is. So you take the data. You can't make up the data. But from a narrative and forecasting perspective, you would say one of those is wrong. Either gold prices have to correct sharply. Gold has to come way down and get back in line with real rates, or the real rates have to crash. They have to come down a lot and get back in line with gold. But one way or another, that gap is going to be reconciled. Either gold prices are going to come down or real rates have to come way down, meaning that line goes up and they get back in sync. My view is that the real rates have got it wrong. In other words, this inflation narrative, the strong growth narrative, the fiscal stimulus narrative coming out of the Trump tax cuts, that none of that is going to materialize the way markets expect. And these real rates are real rates, meaning that they're going to slow the economy. They're not happening because growth is strong, because borrowing demand is high, because thriving enterprises are competing for funds. Those are normal business cycle events that you might see. They're not happening. That's not what we see. What we see is expectations, Fed policy, and other factors taking real rates higher for no good reason. So in my view, that's going to correct by real rates coming down, those lines getting back in sync. In other words, gold is looking through the cycle a little bit. Gold is more forward-leaning than 5-year note rates, and it's saying the Fed's got to back off. The Fed has to switch from this double tightening mode that we described, tightening by raising rates, tightening by reducing the balance sheet, tightening into the teeth of a weak economy. They're going to have to back off. They're not going to cut rates, but they can easily use forward guidance to indicate they're going to skip a rate hike. We might, right now, the kind of stars are aligned for 2 more rate hikes, maybe 3 over the course of the year. I expect, as of now, that they'll hike 1 more time in June, but after that, they're going to hit this wall. If I'm right in the economic forecast, and growth slows, they're going to hit a wall. They're not going to be able to raise for the rest of the year. Real rates are going to go down, and those lines are going to converge. So that's one explanation. But there's another explanation, equally powerful, that has very good evidence, which is that it's just good old-fashioned supply and demand. Gold's saying, hey, the heck with real rates, the heck with all these other correlations. We're going to go our own way because people want gold. When I say people, not Americans, unfortunately. I spoke to a gold dealer recently, and he said, Jim, business is awful. I said, well, I'm always here for you, but business is pretty bad. He showed me some numbers that he gets from the Mint because he's on a special mailing list from the Mint and all that. They were just dismal. Americans don't get it. But, and I don't have to, again, spend a lot of time on the story. Russia, China, and now Iran, secretly, they're non-transparent. Turkey, these are major economies. They're emerging markets, but they're big economies. 80 million people in Iran, 1 billion people in China, upwards of 200 million in Russia, and Turkey, I believe, has about 80 million people. These are very big economies, among the 20 largest in the world. China is second, of course. Buying all the gold they can. And then there's India consumer demand. India, you don't have government demand, but you have consumer. And the mining capacity is not growing. It's barely keeping even. I don't want to get into, peak gold. That may or may not be true. There's some evidence that it is true, but you don't have to go there. You just have to understand that when they took mines offline in 2013, 2014, and 2015, when the price of gold was in a bear market and those mines were not economic. You can't, it's not like throwing a switch. It takes years to get those mines back online. So, and I think that both things are true. I think that gold is correctly anticipating a flip to ease by the Fed, because the Fed's over tightening. They're going to have to reverse course, and that's going to give gold a huge boost later in the year. And there is a supply demand fundamental story there. So again, gold is very strong. It's up as of our doing this podcast. It's outperforming the Dow Jones and the S&P 500 this year. But this bull market goes back to 2015. Gold's up 35%. A lot of strength in the face of a lot of adverse factors. And as those adverse factors flip, the headwind will turn into a tailwind and gold will go even higher. So there's a very bullish scenario for gold right now. And it looks like a great entry point.
All right, good. So let's talk a little bit about forecasting gold, because I think you and I have a lot of the same viewpoints, a lot of the same values when it comes to the way we look at gold. I know you look at gold as insurance. I look at gold as insurance. I think sort of in my experience in the industry, and I've been doing this, I guess this is going on my 11th year, I run into two different kinds of gold investors. The first type of gold investor is basically they're just capital gains oriented. They're looking at a trade. They're looking at gold as a trade. They want to get in, they want to get gains, they want to get out. And then there's another type of investor that is really more interested in gold as sort of an insurance for the rest of their portfolio. So I do tend to notice there are a number of people who follow our podcast, Jim. They follow you. Sometimes they say, well, you know, Jim, you've been talking about gold for X number of years, and I could have done this other trade, or I could have done this other trade, and it hasn't done what I thought it was going to do, and in this time frame, and et cetera. What do you think about that?
Well, two things. Number one, and I've consistently, and you go back, look at my books, look at podcasts, look at interviews. I've consistently done this for years. I've recommended a 10% allocation, 10% of your investable assets. And I have a working definition of investable assets. It's not the same as your net worth. Mm-hmm. So take your home equity, whatever it may be, put that to one side, and also take your business equity. So again, you're a doctor, a lawyer, a dentist, an auto dealer, a dry cleaner, restaurateur, whatever it may be. You've got some equity in your business. Put that to one side, because you don't want to mess around and speculate with your home and your business. That's your livelihood and the roof over your head. So exclude those. Whatever's left, those are your investable assets. It'll be a 401k or a savings account or a stock portfolio, whatever. Take 10% of that, which is less than 10% of your net worth, assuming you've got some equity in the other things, and put that into gold. And, if you want to slice for silver, that's fine, but primarily gold. And so people approach this topic as if it's a binary world. It's as if, Jim, I either have to be 100% in stocks or 100% in gold, and you like gold, and if I'm 100% in gold, I missed out on the stock market. Well, I've never said that. That's a bad portfolio choice. It shouldn't be 100% of one. So it's a false setup. It's a false frame. And honestly, I think a lot of the people who complain about that, if you actually met them in person and drill down a little bit, you find that they've got, that they do have a balanced portfolio. They're just grumpy about the gold part, or they've got one gold coin and no stocks, and they wish they owned 10 shares of Google or whatever it might be. But I think the more thoughtful listener, the more sophisticated viewer understands what I'm saying. So first of all, if you put 10% in anything and it goes down 20%, you took a 2% kind of ding on your portfolio, but you could have been making a lot more on everything else. In other words, if you're 10%, this is not my recommended portfolio, by the way, but if you happen to be 10% gold, 90% stocks, you didn't miss anything in terms of stock market rally. In fact, as I've described, gold has outperformed stocks this year. It has outperformed stocks in the 21st century. It has outperformed stocks in the last couple of years, or at least held its own. As I say, gold's up 35% since the bottom in December 2015. So first of all, gold has not done that poorly. It's not true that gold has done poorly. Gold has actually done very well since 2015. Now, okay, we had a bear market from 2011 to 2015. If you bought, if you backed up the truck and bought gold in August 2011, you're down significantly. You're down 40% or so. I understand that, but that would not have been a prudent decision. You should be buying gold all along. You should be accumulating it. As you get more income, take the 10% slice and buy the gold. Do what you want with the rest, or you should diversify that as well. But I'll leave that to individuals. And then if you're kind of getting an average price as opposed to a peak price, and you're in for a 10% slice, you haven't done that poorly at all. So it's a myth that gold hasn't done well. Gold has done well. It has not had the kind of bubbly activity, at least in recent years, that stocks have. But we've seen lately that that's a two-edged sword. On days when the stock market's down, 4 or 5% in a single day, as it was very recently, and has been more than once. We've had a number of down 3%, down 4% days in the past several months, and as I said, where gold has held its own. So number one, diversify. If you got 90% in stocks and 10% in gold, you've done just fine. You have no cause for complaint. As far as the 10% gold is concerned, people have insurance, as you say. They have fire insurance, they have casualty insurance, they have liability insurance, all kinds of insurance. When you write the insurance check, when you write the check to the insurance company for the premium, you don't think you're throwing your money away. You think you're doing something smart, because how could you sleep at night if you didn't have the insurance? We all know we live in we've seen a lot of natural disasters. We live in a litigious society, et cetera. So you think that's a good use of your money. Well, when you have gold, if stocks outperform gold in some stretch, and sometimes they do, of course, take the opportunity cost. So simple example, so 90% of your portfolio went up 30%. And 10% of your portfolio, which is gold, went up 10%. So what's your opportunity cost? Well, your opportunity cost is 10% of 20%. In other words, 2%. That's what it cost you in terms of overall portfolio performance to be in gold instead of stocks for the 10% slice. It costs you 2%. Well, that's your check. That's the check that you're writing to the insurance company in order to have the insurance in case the stock market fell 20% in one day, which it did, more actually, on October 19th, 1987, or, just did a very quick, down 10% in a couple of weeks, which we've seen twice in recent months. That you write that insurance check, and now you preserve wealth in that portion of the portfolio. But that's not Hurricane Andrew. That's not Hurricane Katrina, what I just described. That's a mild thing, and you're glad you have the gold. Hurricane Katrina in stocks versus gold is when you have a global liquidity crisis, when they shut the stock exchange, which has happened many times, by the way. People kind of ignore that. And the price of gold is going up $100 an ounce a day, $200 an ounce the next day. It's screaming, and you say, get me some gold. This is the only thing that's going to protect my portfolio. And you call the dealer, and the phone's off the hook, and you call the mint, and they're back ordered, and you're watching it go up on TV, and you say, I want some gold. You can't get it. That's Hurricane Katrina. That's the real insurance scenario. That's the reason to have the gold, and you'll be very happy you did. You will not end up unhappy when that happens. So that's my answer, which is just do a 10% slice. When it underperforms, think of it as insurance, which it is, and when it outperforms, you'll be very glad you did.
Yeah, and that whole scenario you just described, where gold's running and people are trying to get it and they can't, is the entire reason that we decided to not trade on the secondary market. So I totally agree with you there. And just kind of as a closing comment before we move on to the next topic is that in my experience, I've noticed that there's kind of a different mindset, as you mentioned, a sophisticated investor versus someone who's maybe not as much. Big difference between somebody who's trying to build their wealth and somebody who's already got wealth and they're trying to protect it. They look at the world differently. And so that makes a big difference.
Yeah. But by the way, let me just drop a quick footnote there, Alex. I was having a dinner recently. I won't mention names, but an individual who would be, let's say a household name, a multi-billionaire, runs one of the biggest hedge funds in the world. It was a private dinner. He's a friend of mine, himself, his wife, and my wife. So just the four of us. And my and we weren't talking about stocks or gold. We were talking about other things that interest us. But my wife has this kind of insatiable curiosity, so she just turned to this gentleman, this hedge fund manager, and said, "By the way, do you own gold?" And he looked at her and said, "Lots." And that was the end of the discussion. The point is, this fund, again, I'm not going to mention the name, but they're multi-strategy. They trade stocks and bonds and commodities and currencies and private equity all day long. And you associate this individual with being a big foot in the stock market, which he is, and et cetera, et cetera. But and I've had more than one encounter like that. But you meet these billionaires who are known for hedge fund stock trading, but you ask them privately, do you own gold? And they say, yes, I do, and a lot of it. So these are the most sophisticated people in the world, and they think it's a good move.
Yeah, I totally agree. I have numerous similar stories to that. We won't get into the weeds on it, but yeah, absolutely. Right. Okay, so let's move on to the next topic. I guess it was February timeframe, pretty serious correction in the U.S. stock markets. So there's been a lot of talk about that. There's been a lot of talk about trade war. What are your thoughts on this?
Well, we are in a trade war, and that has been one of the drivers of the stock market in recent months. So let me unpack that a little bit. I think a lot of the viewers know that my first book, called Currency Wars, and it came out in December 2011. And what I said at the time is that the world is not always in a currency war. But when you are in a currency war, it can go for 10 or 15 or 20 years. And I documented several cases where that was true. And I outlined the dynamics behind that in terms of why it's true. And I said this new currency war began in January 2010. The reason I can pinpoint it is that was President Obama's 2010 State of the Union address, end of January, where he announced the National Export Initiative to double U.S. exports in 5 years. And I said to myself, well, that's interesting. How do you double U.S. exports in 5 years? We're not going to be twice as productive. We're not going to be twice as smart. There aren't going to be twice as many of us. There's only one way to do that, which is to trash the currency. And that's what we did between January 2010 and August 2011. In August 2011, the dollar hit an all-time low using the Fed's broad real index. And I prefer the Fed index to Dixie or DXY. A lot of traders use Dixie. The dollar is down a little bit on that, and that showed dollar weakness at the time. But Dixie is heavily weighted to the euro, so it's almost a euro-US dollar cross rate, and I can get that anywhere. I don't need Dixie to tell me what that's doing. But the Fed index is trade weighted by our actual trading partners, so it tells you more about how the dollar is viewed globally. And that index hit an all-time low in August 2011. So we did trash the dollar. And here we are in 2018, and guess what? The currency wars are going strong, and I expect we'll be back here a year from now, Alex, and the currency wars will still be going on. But I also said that because the reason currency wars go on so long is because they don't have a point of resolution. It's like a tennis match between two good players. It goes back and forth and back and forth. So I devalue, and then you devalue, and then I devalue again, you devalue again, or I'm down and you're up, and then all of a sudden I'm up and you're down, and it goes like this. Major currency. Sorry, Alex, I missed the.
I said it's the so-called race to the bottom.
Yeah, well, yes, it looks like a race to the bottom with one difference. A stock or a bond, or actually a country as a whole, if you want to take Venezuela or Zimbabwe as examples, can go all the way to the bottom. But currencies, they have the dynamic of a race to the bottom. But one difference between currencies and stocks is that they don't go to zero. Major currencies don't. Now, yeah, Zimbabwe dollar did, Venezuela and Bolivar did, and maybe all currencies get there eventually. But at least in the short to intermediate term, major currencies don't go to zero. They can just go up and down like this. So if you look at the euro US dollar cross rate, in the last 10 years, the last 20 years, that has made 20% moves both ways. So in 2000, The euro was about 80 cents. Within a few years, it was $1.60. And $1.60 came back down to $1.20, then it went up to $1.40, then it came all the way down to 105, and now it's back to 125. These are big moves. These are big moves in currency land. In fact, when everyone was bemoaning the lack of volatility in 2017, prior to the recent volatility, they said, hey, we're looking at stocks, we're looking at bonds, there's no volatility. We're looking at the VIX, there's no volatility. I said, look at the currency markets. There's your volatility. And it's true, because that's how countries were managing their growth. They were stealing it from each other in the currency wars. That's what currency wars are. The point being, they go on for so long because they don't have a resolution. After some period of time, 5 years or 10 years, policymakers and leaders wake up to this fact. You would think they would know it already because we have enough history, but they go, we've been fighting these currency wars. They're not really working. We still have the original problem, which is too much debt, not enough growth. Those are the conditions in which currency wars emerged. Too much debt, not enough growth. We saw it in 1919 after World War I, where the Germans owed reparations to the French and British that they couldn't pay. The French and British owed war debts to the United States that they couldn't pay. Nobody could pay anybody. And so you've got this debt overhang. It's standing in the way of growth. And you can't basically pay your debt. It's too much debt, not enough growth. And so your temptation is, I'm going to steal growth from my trading partners by cheapening my currencies. But it doesn't work. So after about 10 years, what happens is they say, hey, I got it. Let's have a trade war. In other words, currency wars bleed into trade wars. They become trade wars. This trade war was completely predictable. It's exactly what happened. The currency war, one of the two that I document, started in 1921, 22 with the Weimar hyperinflation. Then 1925, you had a French Belgium devaluation. In 1931, you had the sterling devaluation. 1933, you had the U.S. dollar devaluation. 1936, the French and British devalued again, the second time. There's this whole series of devaluations. But the trade war started in 1930 with Smoot-Hawley, and then you had a lot of reciprocal tariffs being imposed. And by the way, they can overlap. It's not like, gee, one day the currency war is over and the trade war begins. That's not how it works. The currency war keeps going, but somewhere along the line, the trade war begins, and then you have both. Unfortunately, they end up in a shooting war. So the sequence is currency war first, then trade war, then shooting war. And actually, history shows that shooting wars work. Shooting wars, when there's a lot of destruction and depth, that actually will give you economic growth. It's not a good outcome. It's not an outcome we should wish for, but it does solve the debt problem by wiping out the debtors, and it solves the growth problem by creating so much destruction that you have to rebuild. So save that story for another day. But based on that, the trade wars are 100% predictable because it's exactly what you would expect in kind of year 7 or 8 of a currency war. Now the trade wars have begun. The fact that Trump did this, and I couldn't believe the markets were shocked. I mean, from February 2nd to February 8th, U.S. stock markets had a full correction, down 11%. They ran into correction territory. Everyone's like, oh my goodness, what a surprise. Trump's starting a trade war. So are you kidding? He's been talking about this since the 1980s, like years, decades before he was even a public figure, or certainly before he was a politician. This was his biggest grievance. U.S. is getting ripped off with trade deficits, et cetera. He talked about it. It was in his announcement speech in June 2015 when he announced his running for president. He talked about it all throughout the campaign, et cetera. Now, the only thing that threw people off is that when he was inaugurated, when he got into office in January 2017, he did not launch the trade war immediately after talking about it forever. And there was a reason for that. The reason was North Korea. Because who's our biggest trading partner, one of our biggest trading partners? China. Where do we have the largest trade deficits? China and South Korea. Whose help did we need to deal with North Korea? China and South Korea. So it was the national security team, which at the time was McMaster, Tillerson, Mattis, and General Kelly, and a few others, Dina Merrill and Gary Cohn. It was the national security team saying, Mr. President, don't start this trade war with China and South Korea because we need their help to deal with North Korea. Now you had the trade hawks, what I call the trade troika, That's Wilbur Ross, Secretary of Commerce, Peter Navarro, White House Trade Advisor, and most importantly, and least well known, Robert Lighthizer, who today is the U.S. Trade Representative. They were the ones making the case for tariffs. Well, throughout 2017, the National Security Team won, and the trade troika did not have their voices heard. But what Trump wanted to do the tariffs. And what he realized is that, you know what, China's not really helping. South Korea is not really helping. South Korea is kind of rolling over, acting like a doormat for Kim Jong-un. China's going through the motions. I did a little of this, a little of that, but nothing really substantial. I'm not getting the help I want. So why am I holding off on the trade war if my reason for doing so is not being satisfied, which is I'm not getting the help I want with the North Koreans? So he said, okay, time's up, guys. I gave you a year. You didn't do anything. So game on. And we've seen these are all references to the Trade Act of 1974. There's Section 232 and Section 301. Section 232 allows reciprocal tariffs for dumping. So if you can make a case that China's dumping steel, then you can put a tariff on imported steel. Section 301 is very different. Section 301 has to do with national security considerations. If you can show that the trade or even non-trade practices of a trading partner, of an adversary, are damaging national security, or their economic practices and policies are damaging national security, you can slap penalties and tariffs on that. Trump is doing both. The first round, and the thing that knocked the stock market down in February were these 232 tariffs. He started with solar panels and washing machines. Well, actually, solar panels are big, and so are appliances coming out of mainly out of South Korea, somewhat out of China. But then he dropped the hammer on steel and aluminum, which are much, much more important, much bigger part of the economy. Those were all 232 tariffs. That sent the stock market into correction territory. But very recently, just in the past week or so, he's come back with these 301 tariffs. They needed a report. You can't just do it arbitrarily. But by the way, it's important to note that the president can do this on his own. He does not need congressional approval to impose these tariffs. It's the law. The Congress has already given the president the authority to do this. So he doesn't have to worry about Mitch McConnell and Paul Ryan and Chuck Schumer and Nancy and all those people. These 301 tariffs it's $50 billion on China for openers. There's potential, they say, to go up to $1 trillion, but he's starting with $50 billion. Now, and that's what sent the stock market into a swoon. Now, why did the stock market bounce back? It hasn't come all the way back. It's still well below the highs. The high was January 26. It's down significantly from there. But, you know, there were these days like, last Monday or Monday the 26th when the stock market performed pretty well. Well, the reason is because you get news that maybe the trade war is not so bad after all. So the news that sent the stock market up on Monday the 26th was that China was willing to negotiate. By the way, that's exactly what Trump wanted. Trump didn't want a trade war. He said, I'll start one, but what I really want is for you to come to the table. And China said they would. So stock market goes up. Well, that's fine. The problem is that China has done this forever. They always go through the motions. They say nice things. They put up a good appearance, and then they don't deliver. So, all right, so stocks, enjoy your respite here. Enjoy your good news from China. I don't put much weight on it. As I said, just as the currency wars go on for a decade or more, so do trade wars. They don't have a logical conclusion. It's just back and forth. So, by the way, some of these exemptions that Trump has given, say, hey, you're exempt, or you're exempt, or I'll give you a temporary. That was actually done. It's a little inside baseball, but that was actually done for an unusual reason, which is U.S. companies that buy imported steel, they put those orders in and they agree on a price, and it takes sometimes a month or 2 months for the steel to get fabricated, loaded, shipped, and unloaded. If you put the tariffs on immediately, the steel gets to the port of Los Angeles, let's say, and all of a sudden you got a 25% tariff. Well, that U.S. manufacturer did not price their goods or did not do their deal assuming there were tariffs, because they put the order in maybe last December before the tariffs were imposed. All of a sudden the steel gets to Los Angeles, boom, here's the tariff. So Trump extended the deadline not to be Mr. Nice Guy, not to help the stock market, but just so as not to unduly penalize those U.S. importers who ordered the steel in good faith before the tariffs were imposed. But once that's up, he is going to put the tariff on, because he's going to say, okay, now you've been warned. Now you know if you put your order in mid-February and it's not arriving at the port until May, you know you got to pay a tariff. So don't blame me if it's there. And it also gives you time to redirect those orders to Nucor and U.S. Steel and other U.S. steel manufacturers. So that's not being Mr. Nice Guy. That's just a little bit of trying to achieve some fairness in terms of the speed at which this is implemented on people who didn't expect it. So those are going to come back. Yeah, okay, Mexico and Canada are trying to be nice on NAFTA. China's trying to be nice on bilateral trade negotiation. Let's see where they go. Hopefully, maybe it has a big kumbaya ending, but I don't expect it. I expect the trade war to continue. I expect the stock market to continue to suffer from those headwinds, and I think we have a very long way to go.
Okay, very good. So not to get too far into it, because we have one last important topic we have to discuss, but would you say that it's more about, at this point, the job situation than anything else? And is this sort of reminiscent of what happened with Japan?
Yes, I mean, Japan is a very good example. By the way, now we're talking about the early 1980s, and the situation then was that U.S. auto manufacturers were getting hammered by Japanese imports. Nissan, Toyota, and others were making better cars. I mean, they just were, and they were cheaper, and Americans were buying them, and Detroit was suffering, and unemployment was going up. We had a very, very bad recession in 1981, 82, at the time, the worst recession since the Great Depression, and Detroit was being hollowed out. What President Reagan did, and again, this is important, Reagan's trade advisor, not the ambassador level, the U.S. trade representative, but one of his White House advisors at this time was Robert Lighthizer, who today is the U.S. trade representative, has cabinet rank, has ambassadorial rank. So he's seen this movie before. And what Lighthizer did is he threw steep tariffs on Japanese imported automobiles. He didn't do it to collect money. He did it to force the Japanese to move their manufacturing to the United States. Right. Tariff is a wall, so the goods are flowing like this. You throw up a tariff, it's a 25 or 30% wall on the imported goods. Well, you can pay it, in which case you're non-competitive, or you can jump the wall by moving your manufacturing to the United States. That's what they did. It wasn't just the Japanese, by the way. It was also the Germans. So today, people drive around their BMWs. I got this nice German car. I was like, no, you don't. You have a nice South Carolina car. They're driving around their Hondas. I got this really cool Japanese car, great quality. No, it was made in Tennessee or Kentucky or Ohio. All these cars are, not all of them, but quite a few of them are made in the United States, and those created high-paying jobs. So this idea that tariffs don't work is not true. You hear the whining from the globalists. You hear the whining from the special interests, the global corporations, that taken individually may actually incur some costs associated with this. But America has always thrived on tariffs. Alexander Hamilton, Henry Clay, Abraham Lincoln, they were all in favor of tariffs, in favor of what they called the American plan. Create American factories, support American manufacturing, create American jobs. Reagan did the same thing, and Trump is doing the same thing. Tariffs are as American as apple pie. This whole globalist, Bloomberg, Gary Cohn, Goldman Sachs, academic economists rap you hear about, tariffs or, impose costs on consumers, et cetera. Here and there, yeah, a little bit, but they do a lot more good than they do harm. You have to look at the secondary and tertiary effects, and we have to create high-paying jobs. So there's nothing wrong with being a barista or an Uber driver. Don't get me wrong. I think there's dignity in all work. So if you're an Uber driver or a barista, be the best, make the best coffee you can. But candidly, those are not the jobs that support household formation. Those are not the jobs that support home ownership and bringing up a family and the things that really drive, and income security and pensions. Jobs of the kind I just described come from a number of sources, transportation, technology, but they also come from manufacturing, and that's what Trump's trying to do. So it's not going away, and I think it's done intelligently, and every sign is that with help from Lighthizer, Trump is doing this intelligently. It's as I say, it's as American as apple pie and a very good thing.
Yep. Okay. So moving on. Excuse me, Jen, you and I have been talking about North Korea since I think really towards the beginning of 2017, I think is when we first started talking about North Korea. And then things progressed over the course of 2017, got to the point towards the end of 2017 where you were saying pretty strongly that we were going to be at war with North Korea by March.
Right.
We're in March, and there are people who are asking questions.
Well, fair enough. By the way, I said that, I did say that, and I said it categorically in September, October, and November of 2017. So great thing about doing podcasts and interviews, Alex, is you can always timestamp the commentary. You don't have to guess. By the end of 2017, and certainly now in 2018, that timeline has been pushed out. So let me explain that. So I'll take November of 2017 because that's a fairly late date. I said we'll be at war with North Korea by the end of March. I did not make that up. I got that from Mike Pompeo, who's the director of the CIA, and H.R. McMaster, who's the director of national security. I met with both of them personally in Washington, D.C. So again, and I agreed with that forecast, by the way. I wasn't just parodying what they said. That was my analysis. That was their analysis. But what you have to understand is that that's based on conditions or circumstances,
Right.
And those circumstances change. And when they change, you have to change your forecast. And Pompeo has asked the same question. You can ask me, and that's fine. I'm happy to answer it. But they asked Pompeo. They said, Mr. Director, you said 5 months. That's what he said in October. 5 months happened to be March. You said 5 months. We're 4 months into it. What happened? Well, the answer is, he said it was 5 months then, and it's 5 months now. In other words, it's a 5 month window. Here's the way to put it. North Korea is 5 months away, maybe less, from building a nuclear arsenal, an arsenal of ICBMs tipped with nuclear weapons that can end U.S. civilization. Enough of them, I would say 10 would be enough, so that even with our anti-missile defenses, 4 or 5 of them get through, and you destroy, Seattle, Denver, L.A., and Chicago. Well, America's over at that point. We'd fight back and we destroy North Korea, and we'd pick up the pieces. But that's a scenario under which the veneer of civilization gets pulled away, and you get, apart from death and destruction, you get some pretty bad results. That's an existential crisis that no president, no flag officer, no admiral, 4-star general will ever allow. So they're 5 months away from that. Now, that's what Pompeo meant when he said that in October, and that's how I understood it. What happened was we have a timeout, and as we hit the pause button, it's kind of like a 2-hour movie. Alex, I have the movie in the Blu-ray player, right, or Netflix. It's downloaded, and it's a 2-hour movie. And I say, Alex, this movie's going to be over in 2 hours. And 1 hour into it, we hit the pause button, and we get up and we get some popcorn and snacks or whatever, and we come back. Well, it's not going to be over in 2 hours. It's going to be over in 2.5 hours because we hit the pause button for a half hour. It doesn't mean you're wrong about the 2 hours. What it means is that somebody hit the pause button, and you have to take that into account. Well, North Korea and the United States together hit the pause button, and they did this in early December, and It had to do with the Olympics, and we knew the Olympics were coming, so that wasn't new news. But what happened was the U.S. has been conducting joint military exercises with the Koreans and the Japanese for a long time. We do this with military forces all over the world. We do it in Europe. We do it all over the place. But there's no doubt that this was one of the hot zones and one of the areas where troops need to be prepared. If you've been fighting, if you're the 101st Airborne and you've been fighting in the desert from, Mosul to Kirkuk, and all of a sudden we say, your mission is to land behind enemy lines in the mountains in the middle of winter. Well, you got to do some mountain training. You got to get up to Alaska or the Rockies or wherever. And that's same for the bomber pilots and the Navy. Everyone's got to change their. So this training is very, very important. Mm-hmm. We've been doing it on the regular bit. And North Korea has been shooting missiles, setting off atomic weapons, firing missiles, again, on a much faster tempo under Kim Jong-un than either his father or his grandfather. His grandfather didn't have missiles, but he wanted them. So the idea was called freeze for freeze. We, North Korea, will freeze our weapons and missile development if you, the United States, freeze your operational tempo in terms of military exercises. And Russia and China supported this. North Korea wanted. The U.S. refused. The U.S. said, no, we're not going to let North Korea dictate the operational tempo of our training. We have to do what we have to do. If you want to get rid of your weapons, we're all for that. We'll talk to you about that. But you're not going to tell us how to run our military.
Right.
But in December, President Moon of South Korea turned to the United States and in kind of a soft voice said, hey, guys, do you think we could just, postpone these exercises, not end them, but just postpone them until the Olympics are over so that nobody makes a mistake or does a provocative act in the middle of the Olympics? The U.S. kind of said in a very quiet voice, okay. At which point, Kim Jong-un stopped firing missiles. His last missile test was November 2017.
Yeah.
His last nuclear weapons test was September 2017. So we fell into a freeze for freeze, so-called, hitting the pause button, as I described it, without anybody losing face, with no formal announcement. Nobody said they wouldn't start it up again. And so that's what happened. And so from December, January, February, now into March, we've hit the pause button. The question is, do we now have our popcorn and snacks? Are we ready to kind of hit play and let the movie keep playing out? And the answer is possibly, because the U.S. has scheduled military exercises for April. So let's see what happens. Now, on top of that, in the midst of that, we had some Olympic diplomacy with Kim Jong-un's sister and Ivanka Trump and Mike Pence, all these people showing up in Pyeongchang for the Olympics. Who knows who said what to whom behind the scenes, but suddenly the South Koreans come out and standing in the West Wing driveway or the lawn outside the West Wing, they go, oh, by the way, we just met with President Trump and we told him that North Korea wants a summit, that they'll meet with Trump. And then 2 hours later, Trump walks into gets in front of the press and says, yeah, I'm willing to meet with Kim Jong-un and we try to do it before the end of May. So that was like hitting the pause button a second time. Where does that stand? Well, no one knows. The North Koreans have not responded to that. The South Koreans said publicly that the North Koreans told them they would have a summit and Trump agreed, but the North Koreans themselves have never said this publicly. It doesn't mean it's not happening, but there's something kind of strange about that. And now, our friend Kim Jong-un looks like he might be in Beijing right now. He doesn't travel by plane. He goes by train, and he has a special armored train, specially constructed armored train that he travels in. He doesn't go far because how far can you go by train? Japanese satellite surveillance and Japanese media have reported that train is in Beijing. Now, is Kim Jong-un on the train? Hard to say, but there's good reason to believe that he is, which means he's meeting with the Chinese leadership. So there's some behind-the-scenes diplomacy. I doubt this meeting will happen in May. The reason I say that is it takes a very long time to prepare. You can't wing it. There's a lot of intelligence collection. There's a lot of analysis. There's a lot of game theory, a lot of game playing. You're gaming it. What if they say this? What do we do? Or what if they say that? What's our response? You got to do this all in game theoretic space. You have to brief the president. That takes like 6 months if you're lucky. So, and then there's the logistics. Where are you going to have this summit? Are you going to have it in in the demilitarized zone? It's not exactly like a Ritz-Carlton up there. I mean, I haven't been there, but I've studied it. There's a lot of reporting about it. It's a pretty Spartan environment, and there's no way you could secure the safety of the president of the United States on the border with North Korea. Maybe it will be there, but that's a heavy lift. It's not going to be in South Korea because the North Korean president doesn't want to lose face. Probably not going to be in China. It could, but the North Koreans don't want to appear to be kowtowing to the Chinese. It's not going to be in Japan for the same reason, and the Japanese and Koreans hate each other, and the guy doesn't fly. And it's not going to be in the United States. Through a process of elimination, the most logical place actually is Russia, because they do stand back from this a little bit, and you can go by train from North Korea to Russia. You could have it in Vladivostok. Now, this would, imagine the impact of this on the whole Russia collusion story. I mean,
Oh yeah,
I don't want to get too far down the weeds. I probably already am, but this would vindicate every Russia conspiracy theory we've ever had. But hey, it's Russia. You know, you have to expect that. So,
yeah.
So let's see. So my answer to someone who says, "Hey Jim, last fall you said March. It's March. There's no war." My answer is yes, but it's a 2-hour movie. Somebody hit the pause button. It's still a 2-hour movie, but we're on pause. Let's see if somebody hits play and we get back to this scenario. So it's still on the table, but look, I'm a good Bayesian, you know, as John Maynard Keynes, and this is a quote attributed to a lot of people. I don't know who actually said it, but it's a good quote, which is, you know, when the facts change, I change my mind. What do you do? Meaning a good analyst will update the forecast. So it's still on the table, but on hold for the moment.
Okay, very good. So I think, yeah, as you said, I think the major two major takeaways from that are, number one, sometimes people tend to look at a forecast as if it's written in stone tablets by the finger of God, when in reality it's a fluid situation. And as you said, facts can change. You have to update.
Yeah. And by the way, I just explained that on this podcast, but what the explanation I just gave, I've been saying since January. It's not like I waited till March to update. And so again, I think we maybe even covered some of the same ground in all your podcasts and certainly on Twitter and the other platforms. So I'm not a lot of what I do is for free in the sense that we make it publicly available. So I'm not trying to sell subscriptions, but for regular listeners and viewers, you sort of have to stay with the story. You can't come in the middle and you know, raise your hand about timing, because we updated this a while ago.
And then the other part is that the story is still continuing. It's not done yet, right? So this play button can be pressed again, really at any time as soon as they start weapon testing, basically.
Well, that's right. Well, the play button, in one sense, is somebody's got a finger on the play button, because we are going to have these military exercises in April. They're on. But Kim Jong-un has said, hey, I kind of understand that you have to do that, so that's not a trigger for me to go ahead and fire a missile. But, by the way, there's a lot of weapons development you can do without launching missiles or detonating nuclear weapons. You can test what's called ruggedization in wind tunnels. You know, you fly a missile into like a super jet engine, turbocharged jet engine exhaust. Right. So there is stuff you can do, and I'm sure they are doing it. And they are moving the ball forward in the way that Mike Pompeo described. And then the last thing is McMaster is gone, replaced by Bolton, John Bolton, who's more of a hawk, and Tillerson, who is on the dovish side, is gone, replaced by Pompeo, who is more of a hawk at the State Department. And his replacement, CIA, is the very hard case. Very well, Gina Haspel is very well respected inside the agency. So you've now got more hardliners than you did when the pause button was hit. So if we hit the play button, it's going to be a very tough case.
Okay, very good. Jim, that about does it for our time today. I just want to thank you for being on with me as usual. I think this was a great discussion and look forward to doing it again next time.
Thank you, Alex.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by